Hello everyone, welcome back to my channel. Today's video might be one of the most important ones that I post on this channel. And that is because the concept that I'm going to try to communicate to you today is so mind-blowing that if you truly grasp this strategy, if you truly grasp the power of options as a compounding vehicle, you might be able to bring your portfolio to levels that you have not seen before. You see, most people use options as a way to trade, but I truly believe that within options there is the power, the compounding power, to be able to take your investment to levels that are just hard to grasp. Okay, so with that, let's jump right into it. What you see here is the Black-Scholes model. This model was developed back in 1968 by two mathematicians who actually won the Nobel Prize with this. And that is because after they developed this model, the derivative industry was just revolutionized by the way they were able to fairly price derivative products. Now, if you look at closely, you will see that there is a term at the end of this call price model. And for those of you who are familiar with compounding interest, you will find this familiar as well. And that is because this term over here simply just is a way to discount the value of the call option to today's price. And what you see more closely is that it uses the interest rate and also an element of time in here, which tells you right away within the options model, there is a way to compound your investments. All right, so with this, I'm going to run you through a quick exercise to illustrate this point. Let's say you're focusing on a stock. Let's just choose any stock, in this case, Tesla. And let's say you think that Tesla is valued at a price that is much lower than what is trading today. Let's say you run a fair valuation of Tesla and you think that the true price of the stock should be $130. And I will explain why as we go forward with the example. So let's go forward 1 year. Now we are in September of 2024. So let's look at call options expired in September 2025. And then we say that the fair valuation of Tesla is around $130 per share. So we see here that the call position on Tesla, the 130 strike, is currently having a premium of $113. And I'm just using round numbers here. So how this exercise is going to look will be something like this. You go in the market and you buy 100 shares of Tesla. So for that, you're going to spend approximately $22,900 at today's value. Then immediately you are going to turn around and sell a call option deeply in the money for that 130 strike price. So you're going to sell a call. The call is going to be expiring in September 2025. And for that, you're going to receive a cash value of $11,300. That is $113 per share. So after that transaction, your account is going to look something like this. You're still going to have the value of those 100 shares of Tesla. So those are shares. you're going to have a negative value for the call option you just sold. So that will be $11,300. Let's call that the call option. And then you're going to have cash, which is going to be $11,300. Now, as we move forward in time, you're going to see that these two numbers are going to vary. If the shares goes up in price, you're going to see that this number increases, and this negative number is going to increase as well. But in a way, they are going to offset as well. And the same thing is going to happen if the share price decreases. This value is going to decrease, but this negative number is going to decrease as well. In other words, adding value to your portfolio. But this portion here is going to remain fixed. Why? That is cash. That is not trading. That is just cash sitting in your account. Okay. So in September 2025, two things are going to happen. We're either going to be trading above $130 a share or below $130 a share. So let's explore both scenarios. Scenario number one, let's say the shares are trading at above $100 a share. So your account is going to look something like this. Those shares are going to be called away. In other words, you're going to receive the money for which you sold it for. In this case, you sold the strike price of $130, so you're going to receive $130 a share, or $13,000. Plus, you no longer will have the shares, but you're still going to keep the cash that you have originally in the account, $11,300. So all in all, we're basically going to have $24,300. Okay, so what's our profit? Well, we're going to end up with $24,300 minus $22,900. That's going to be a profit of $1,400. So let's write here our profit of $1,400. So at the end of this transaction, you're going to end up with more money of what you started. But what is your true return? You see, most people will say that the return is $1,400 over the original cost of $22,900. And that is not the case. The return is really $1,400 over the portion of the portfolio that was truly invested. You see, throughout this year, we didn't raise this cash. The cash was out at the moment we initiated the transaction. All we did is we purchased 100 shares and we immediately sold them, receiving a portion of the cash. So, in other words, all we raised was $22,900 minus $11,300. So we just raised $11,600. So let's use that as our cost basis. And that is approximately 12% rate of return. Again, why is this the case? Think of it at this portion of the transaction, think of it as a bond. If you are buying a bond, you are paying less money, but at maturity, you're receiving more money. You're receiving what we call the face value of the bond. And I have here a calculator. Basically, this calculator is a bond yield calculator. If you see, we're having a current price of $11,600, a par value of $13,000, which is the money we're going to receive at maturity. This bond is going to mature in 1 year. And so that gives us a yield to maturity of approximately 12%. And that is exactly what we're having here. All right, so that is a scenario number one. You right away can see that we are having a profit, we are risking less money, and we are still making a very good return on our investment. But what happens if the shares of Tesla at the end of this year are trading at a less of our strike price? So that brings us to a scenario number two. Well, in that case, your account balance is going to be something like this. You're still going to hold the 100 shares of Tesla plus the cash that you originally have after selling the call options. Now, these 100 shares is going to be worth wherever Tesla is trading at that point. But remember we said when we selected this call option with this strike price that we think that the fair valuation of Tesla is $130 per share. Well, here we are continuously holding that 100 shares of Tesla. And because Tesla is trading at a price that is less of $130, if we have those shares of Tesla, well, it means that we just basically enter the investment at a price that is less of $130. In other words, what is our cost position for these 100 shares? Well, the cost of those shares is $22,900 minus $11,300 or $11,600 for 100 shares or $116 per share. And there you have it. That is our cost basis for the shares. Now, from here on, if you still think that you want to be a holder in Tesla, you will just wait until the company or the shares go up in price again. This is why we wanted to basically select a strike price where we think that the company is fairly valued. But I know for a lot of investors, they don't mind if the share goes down in value for some period of time because they are willing to hold for the long term. However, with this way, it gives you an option to be able to hold the stock at a much lower price. Think about it. Today, the shares are trading at $229 per share. And if they go down, you are basically securing $116 per share. Now, obviously, if they go lower than that, that is a risk associated with the investment. But I mean, look at this strategy. The stock price will truly have to drop over 50% in order for you to have to be forced to hold the shares if that is what you're looking for. But if the shares increases in price, you're looking at approximately 12% return. And this is only in a matter of time of 1 year. You can be doing this year after year after year, continuously compounding your investment and continuously improving your cost basis on the shares that you are holding. Okay, so let me know if you have any questions about this strategy. Look at the call options of any stock, not just Tesla, and just see how everything varies with respect to the strike price that you select to sell in the future. If you have any questions, let me know in the comments, and I would love to hear your thoughts about this type of a strategy. Thank you so much for watching, and I will see you on the next one.